before you go buying anything, do a full feasibility, as in what's your end value is going to be if you are going to develop it. You want to allow for holding costs, buying costs, and if you're going to sell it, selling costs. The typical price in Harrisdale for a house is $883,517. It's almost crazy to say that for Perth because over the last year, the typical price has increased by 22.64%.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day and welcome to our first Q&A episode of 2025. I'm still getting used to saying the year, so apologies if I slip at any of these new episodes. But today I'm diving into some of the interesting questions that have been asked across the break on our Perth Property Investment Facebook group. And I've chosen a few meaty ones that I can dive into and pull apart to give you some insights on areas that I haven't covered in anywhere near as much depth in the past. So I think it's going to be a really interesting episode. And if you're not already a member of our Facebook group, head over to Facebook, search for Perth Property Investment. There's a link in the show notes to come on over and join the conversations. I usually let most of our community sort of reply, I occasionally chime in, but I do like to pull out the select issues or questions getting raised when I think that our wider listeners can have benefit from tuning into them as well. So without further ado, let us dive into the first question I'm covering today. Someone here is looking at a block of land in Manning, city of South Perth. It's become available, which is 870 square metres, zoned R30. And they're saying, anyone know, can I put 3 residences on it or just 2? And while I suggest always involving an expert in either subdivision, surveying or town planning, depending on the degree of complexity, more the expert on subdivision or surveying if it's lower complexity, town planning if it's, if you're looking at multi-unit apartment complexes and greater complexity with challenges to get over that those first 2 experts can't answer. If you go and take every single property to them and ask them, can you subdivide this? They're going to get pretty frustrated with you quickly. And let me just give you the down low on that. So what you want to do is educate yourself on the basics so that you can do a back of the envelope or a high level check to see if the property is going to stack up at least high level before you go getting their input. And I would expect to pay for their input when you go to that more serious stage of wanting to vet the property further. So if you're paying for their time, you want to make best use of it, you want to get value for money, so it's no point asking them very basic questions. You want to at least check out, verify that the R coding is R30. A good starting point is to call the council, ask to speak to a town planner, confirm the R code, ask them what is the R code. You could also look up, in this case, it'd be South Perth Intramaps if you could go to Google, or you can find Intramaps through the South Perth City Council's website. And you can bring up the property and check the zoning overlay and see what the zoning is. Just verify that, but never take a real estate agent for what they say. Because the other thing is that sometimes there can be a split coding on the property. So it could be 17.5/30, and there might be conditions involved to develop at that higher density coding. So you want to really check with council in each case. An expert would certainly be looking at doing that if they needed to as well, if you did speak to them. So in this case, let's say we've done that, we've verified an Intramap that's R30, you could speak to the town planner as well and just ask them, what can be developed on the property? But a lot of town planners probably get frustrated with very basic questions too. So again, best use of everyone's time. What I suggest you do is you type into Google and get yourself a copy of the R codes. So if you search for R codes WA, go to the state government page and you can download a copy of them. So at the moment, volume 1 of the R codes applies for R60 properties and below. And in this case, let's say we've confirmed that it's an R30. So it's going to be volume 1 that you check. And in that volume, the table that you want to check out is at the very end. It's table D, page 125 from memory. And the table is titled Site Area Requirements. So what you want to do, and I do this virtually every time that I'm checking a site to appraise it for sale, I want to know what coding it is, what can be developed, and what potential it has, because that's going to affect the value of a property significantly. And likewise, we look at it on our buyer's agency side too. We want to find those hidden surprises, and a bonus potential is really great, even if you don't intend to develop the property, because it's going to add value that might not have been taken into account in the price that the seller's wanting. Now, let's say we found, we know the property's R30. Under R30, the minimum area for an individual site is 260 square meters. And the average area is 300 square meters. You can see that in the table. That's the same for both a group dwelling, which is like a villa or townhouses, or that also applies to a single house. So in order to divide this property into three, our high-level check needs to be that the average site area of 300 square meters, multiply that by 3, you need 900 square meters. This property is 870 square meters. So on the face of it, it doesn't clearly meet the R codes. Now, it's worth knowing that you can apply to the WAPC for a 5% variation, but there's going to be conditions attached to whether you can do that. And it's not always a given that you're going to get that granted. So it adds another risk factor that you could purchase it and not be able to divide it into 3, and then it may not be profitable. So that's where you really do need to consult an expert, find out if it meets all the criteria, and find out what are the chances of getting the approval to do it, to do a 3-unit subdivision. So that's where, if you went to the expert and you said you realize this, you want advice on this specific area, they're going to be a lot more accommodating of that type of question, and they can really add their expertise and add a lot of value to your overall decision. So there can also be other factors, not just the site area, that prohibit subdivision. And even if it met the R codes, let's say it was a 910 square meters, which is a very common site size, and in that case, if it was R30, it would meet that 300 times 3 criteria for the 3 units. We then want to take a deeper look at some of the other things. So what's the slope on the block? Is it relatively flat? That's great. You don't want to be having to undergo lots of retaining costs or costs for pumping of sewage, etc., if it's on a downward slope from the road. So slope of blocks are a very big one that affects profitability. You want to check if it's in a flood-prone area, so you can type flood-prone maps WA and search the address and see if it's in that area. You want to make sure it's not in a bushfire-prone area too, so you type bushfire-prone map WA, check that it's not in there. And those are other good high-level checks. Those 3 things are the biggest cost blowout things that I tend to see. Then you want to really, before you go buying anything, do a full feasibility, as in what's your end values going to be if you are going to develop it. You want to allow for holding costs, buying costs, and if you're going to sell it, selling costs. We don't just do a development for the pure love of seeing something get built, especially at the moment. The time involved is still longer. The interest costs are higher. The overall risk is still higher, I guess, to do it. The market could change in the time period that you're looking at. So you really want to make sure that you're going to make at least, preferably, a 12% profit margin. Maybe if you already own the land and you're planning, you just want to convert it to a higher rental usage so that you've got some rent coming in on it, and you don't want to just sit and hold it with nothing on the property, then maybe you'd accept a 10% return on total investment, on total outlay. But really, you want to be looking at 15% if possible, and also building into that some fat for contingency for cost overruns or your end sale price not being 100% right. And it is hard to come up with end sale prices at the moment because so few people have been developing. So that also makes it hard to come up with a reliable price and be sure that you can get it. So we're in a bit of a limbo period where it's hard in general to move a development forward, and I'd be very surprised if it did stack up. Not impossible, but more likely not to than it is to. So hopefully that hasn't hurt your head. My real point there was to get familiar with the R codes table, be able to make those basic checks, and the council, town planners are a good resource, can sort of help explain that all to you as well. And, there's other questions that you can ask them when you've got them on the phone, such as, is there anything else I need to know if I was going to develop this property? Is there any contributions payable that you're aware of? Is there anything that might hold the development back, or any problems that you need to be aware of? So those are all good questions, and they can help top level to see whether it's worth going deeper on the property and engaging an expert. I'd suggest doing all of that before you put an offer in, or having a due diligence clause giving you the time to put all that research together and make sure that it stacks up. So a bit of a long answer there, but hopefully everyone's picked up a few things, and it was good to revisit development, because, to be honest, in the last 5 years, we've had very few clients develop stuff. Even still, we've got a dribble of clients that are starting to finish some developments that they've gone ahead with over the last 18 odd months. So good to see a handful of those coming through, but really it's been so hard, it's taken so long and been so uncertain that that's why we've got such a supply problem here in Perth. So hopefully the conditions will keep improving. The gap between established and new is going to keep closing, and it'll be more viable to start developing, and we'll be seeing more of this type of property moving forward. And hopefully our clients will be making some good profits when they do start doing it. Now, next question. Anyone here familiar with Harrisdale area? Now, Harrisdale, if you don't know, is southeast of Perth, sort of on the back of Canning Vale, Southern River, and it's got Piara Waters next to it. So the person's commenting here, the price seems so high, especially for those smaller blocks around 250 square metres. Do you think it's really worth buying an investment property there? Would love to hear your thoughts or experiences before making a decision. Now, I thought I'd deep dive on a individual suburb so that you can see, I guess, how our methodology for research and some of the things that go into our trifecta review have evolved over the last year. And I've seen the need to become even more deeper into the analysis to improve the chances of buying in the best possible area, and to be even more selective as our market has continued to evolve. So I'm always learning. I love continuing to improve, and our trifecta review, especially of late, has become a lot more involved and a lot more detailed, and the reliability of how we can then predict both short-term growth and longer-term, growth over a whole period of sort of 7 to 10 years, the most reliable methodology that we've ever used. So I'm excited that we can be adding that value to the suburb and property selection for our clients. I believe it's really unique, and I've taken the best of what's available from fabulous data tools that are out there, and combine that with my own methodology that I've learned from a lot of other experts over the years, and having used a lot of buyer's agents as well. I've seen the best of what they do and seen how they can overcomplicate things and not even focus on the important things. And I've tried to keep distilling that down into how do we make the best overall selection. So that's the background. Now let's talk about Harrisdale and some of the things that I'm going to look at on whether that's a good purchase. And then I'm going to go from the suburb down to the specific property type that this person's mentioning. So at the moment, the typical price in Harrisdale for a house is $883,517. It's almost crazy to say that for Perth, isn't it? Because over the last year, the typical price has increased by 22.64%, so slightly above what the median in Perth has done, which I think was very similar to that, 22 or 21%. And over the last 10 years, the typical price in Harrisdale has risen by 70.76%. So it's done very well and had a significant increase in its price over that time. So it's certainly become, of late, the next Canning Vale, you'd call it, with the decent shopping centre that's at the core. It's got pretty reasonable quality schools. And I hear the buzz around is that the principal of Rossmoyne has come to the high school there, and they're focusing on making it a top public school. Now, I'm pretty certain it was the principal of Rossmoyne, not the principal of Willetton, but either of those schools have done exceptionally well. And if that's the case, then there's going to be a real force driving that school and making it top quality for the students there, as they previously did at one of those two other schools. So Harrisdale's also benefited from the demand for newer properties in a master planned area, nice surroundings, and that demand has exceeded the supply of new land that was continuing to come on in the area and was subduing prices somewhat. So now that more of the suburbs built up, land has struggled to get developed, as I was just talking about in our last question. So not only has it been difficult to develop small blocks, it's been very difficult to develop larger blocks too. So all development is behind. It's affected land supply across the board. Demand's therefore exceeded supply. A lot of the suburb, I'd say, looking at the aerial, about 2/3 to 3/4 of the suburb is built up now. So it's a lot more established than it used to be. So eventually, when the land does come on, it might reduce some of the pressure on prices, but it's going to depend on just how popular it gets in the meantime. And the biggest thing that drives families' decisions is the schools, because we've got really great infrastructure in place with the amenities. It's really going to come down to the schools and how well they do. And that could really, it's a bit of a wild card, but certainly a very big positive thing if they continue to improve. So what gave me good confidence for the shorter term is that the building approval ratio is just 0.84% of the existing overall number of properties in the area. So very low building approval ratio. We try to stick to areas that are less than 1.75 or less than 2%. And that enables us not to have, too much supply coming on to compete with existing established properties. So a building approval ratio low, good sign still for the shorter term. And then when we go deeper to look at some of the other underlying fundamentals, it looks like there's some good growth ahead in the shorter term, with the days on market being relatively low and still trending down. The stock on market being very low at 0.38%. So, when we are looking at any suburb, we want the supply to be tight. So we ideally want that stock on market to be less than 1.5%. And that's one of our criteria that we have been imposing. And I mentioned the BA ratio, the building approval ratio, ideally less than 1.5 to 1.75, but we look at up to 2% and under. Now, as we go deeper, I also like the inventory level to be tight. So that's how many months of supply relative to the demand there is. I want the trend in that, to be going the right way. So we don't want, we want to see a downward trend and tightening of the inventory. So I rule suburbs out immediately when they start either trending up in supply or trending up in inventory. And that's really critical. So they're all still trending the right way. That's a good sign for the shorter term growth. And then when we look further into things, the whole period at the moment is 6.1 years. Ideally, I like it to be at least 7 years, because if you're planning to hold for at least a cycle, you want as much stability in the turnover of properties, and that reduces the supply that's going to keep coming on. So imagine if you've got a whole period of 3 years in a suburb, then you're going to have properties turning over 3 times in 10 years, whereas at 6 years, much tighter supply. of overall properties, but we have seen much more stable suburbs. So I think that's in part because a lot of people initially bought into Harrisdale as their first homes. They're now using that equity to upgrade, and that's to leapfrog into other areas. So because the suburb's sort of changing in that regard, it's reduced that sort of hold period a bit. So it's still okay on the hold period. It was one of the areas that I would like to see a little bit higher. And what was also encouraging is that the affordability index, when we compare it to other suburbs, was 35.4, and many Perth suburbs are now pushing over 40. So it's still relatively affordable for the residents to keep paying more for properties there. And when I couple that with the ERSAD, which is the Relative Economic Advantage and Disadvantage Index, it's a very strong 8, just showing that it's got relative strength and ability for the residents there to have greater financial resources and ultimately pay more for their rent and more for their properties there. So all of those fundamentals look really good to me, both for a hold over the short term and the longer term. And the only thing that gives me pause for thought and why we wouldn't be potentially having this as one of our top areas to buy in is that the land supply, when you pull up the aerial, is still a lot all around it, and it does introduce that wild card where if the demand doesn't keep up with it, growth could go back to being subdued again for a while. So that's the real wild card why I think there's still better choices out there. But when we look at this sort of specific property type that this person's looking at, a 220 to 250 square metre green title block with a 3-bedroom, 2-bathroom property on. The benefit there is that it is green title, so you don't have a strata fee eating into it. They didn't set any of them up to be strata that I'm aware of in and around the town centre. And they're currently selling for 660 to 690, 660 to 690,000. And we're getting at the moment 660 to 690 per week rent. So the yield's still very good. And that's also supportive to me that the prices haven't outstripped the rental yield yet. And, that's pretty much on 5%. So pretty reasonable rental yield still. And that tells me that, again, compared to what's happened in some other areas where, now yields are dropping more to 4%, high threes, you're still able to get a pretty good rental yield there. So not too bad on that front. And all in all, it probably, I know it's not one of our top choices because of that land supply wild factor. But it's not a bad choice, especially if you're looking at wanting to buy a newer property, because most of them in the suburb are 8 to 10 years old, and you're still going to have relatively low maintenance and reasonable depreciation from a property like that, as opposed to buying in a much more established area. So the trade-off there is newer property, but potential risk on the land supply. All in all, we haven't bought any properties there for clients, but I can see some merit in considering it. I think there's better options. Finally, next question. We've got a couple more. We'll see how much time we've got. So next question. Thoughts. If you can get just a good deal direct with the bank as you can through a broker, what would you do? I asked the question, how do you know if it's a good deal if you haven't actually gone and done the comparisons? And until you do the comparisons, you're not going to know. And it's way too tedious to do these yourself. So why wouldn't you engage a finance broker that isn't going to have a cost associated with using them? Loyalty, in my experience, to the banks doesn't get rewarded. So if you have been offered a special rate and you think that that's not going to be beaten, I would be upfront with your finance broker, tell them what rate that the bank's offered you directly, see if they can beat it, and be clear with them that if they can't beat it, then you're likely to just stick with the same bank and stay with them, and that may mean that they don't get paid a commission, potentially. But I would also be a lot more holistic in how you're considering which loan to go with, because the interest rate is only one of the variables that you should consider. There's various policies, and you might be able to stretch your borrowing capacity further with other lenders that could get you into other options to purchase property, a higher price property that you thought, was out of reach. So it's not always about interest rate. And you want to compare apples with apples and make sure that if you've got an offset account that you want attached to it, that you're also comparing that with one that does, and that the other inclusions match your needs. And that's what a broker is really going to do. They're going to tailor the options they put before you to your situation. So I just don't know why you wouldn't use one. Why, if you're going to prepare your financials for the bank anyway, why not just prepare them for your broker and have them, shop it around and see what's the best that they can come up with. Next question. Seeking to invest for the first time as I've accrued enough equity to purchase 2 homes to the value of $750K each. It appears as I calculate my financial position that in order to negatively gear whilst remaining close to cash flow positive, building a new home is the go, mainly due to capital depreciation, tax deductions. Thoughts? Now, this person's probably right that you're going to have a much better chance of breaking even on your cash flow if you did build a new property, because you're going to have that depreciation to help with your holding cost. And you're also going to have a higher building component to the overall property that's going to see you attract a higher rent. And that doesn't come without trade-offs, unfortunately, which is what you need to understand. So I always go back to what's your primary reason for investing? And typically a new property, especially at the sort of price that you're talking about, is going to be in an estate with lots of land supply. So that's going to keep pressure on prices being subdued. Like I was just talking about in the previous question. I guess all these questions are kind of going together, aren't they? You go and develop your own land, often where that profit comes from is not so much in the building of the house. It's usually in the creation of that extra title and taking the land to its higher value. Yes, the easiest way to sell it can be to go and build those yourself, but I would always be looking at what's the extra profit that you may or may not receive from building it. Is there a market for land? How tight is the supply of land in an area? And that's worth looking at when you're coming to buy your home, because we really want to look at, if you've got stage after stage after stage all planned to come on, they don't always increase if the demand's not there to match it. So yes, the estate can plan to increase prices between stages, and they will tell you, look, you can't lose because we plan to release the next stage at a higher price. But I've also seen the reality of that when the market cools and they need to get buyers, and they're giving away cars to find buyers. So if you can get into an established area with building, that could be a middle ground to consider, where you're buying into an area that has limited land supply, potentially. So you're not going to have that ongoing land being added to things. So while the property may be easier to hold because it's got a higher rent, you're definitely, in most cases, trading off the potential level of capital growth that you can achieve, at least until such time that the area is more established and the land supply is taken up. That's what we've seen happen with Canning Vale. It did sit for a long time and didn't do that well. And now that the land supply is taken up, demand's exceeded supply for this time period, it has done well. So in my experience and what I've seen for people is that getting decent and high capital growth on a property, that's what can change your life and give you a lot of choices. And that does come at a price usually, and you're not usually going to get higher and high rental yield while also getting high capital growth. That's the trade-off. So for me, chasing the growth is the most important thing, because that's going to give you choices. Whereas, yes, you need to make enough on the property to be able to hold it, not to be under any pressure. But I think growth needs to be the primary choice, and that should dictate the type of property that you buy and where you buy it. So in most cases, that's not going to be a new property in a land estate. I can almost promise you it's never going to be in a new land estate. But if you've got a longer time frame, if you are really worried about the negative gearing on a property, if that's the difference between you getting in the market and not, then by all means look to something that does have a higher rental yield to make it more manageable for you. Okay, final question. Hi, I have 180,000 equity in my primary residence and I'm wanting to purchase a block next door for 180,000. What's the best thing to do to go about purchasing this block? Now, very quickly, I think it'd be worth reaching out to a local agent or a buyer's agent to give you some input on the likely market value of that property. Just because you've got 180k equity doesn't mean that the place next door is going to be worth 180k or even possible to buy for that. So see what it's worth by chatting to an expert. Then you need to track down the owner ultimately so that you can see from them if you can buy it. Agents, such as myself, have a lot of access to a lot of data that the public doesn't. So it could be worth engaging a buyer's agent to hunt these owners down, or speaking to the sales agent that previously sold them the property to the owners, if it was any time recently, because they may have their contact details. And the agent may be able to find their number and try to contact them that way, or they may be able to find out where they live and send them a letter. And ultimately, you really want to convey that you're ready to buy. It's going to be a simple purchase for them, can make decisions quickly, ready to, cashed up, pre-approved, ready to buy. So that's our final question answered. I hope these have been of value to you. If you've enjoyed the episode, like and share it with your friends. Head on over to Perth Property Investment Facebook group if you're not already a member. And I'll catch you on the next episode. See ya.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.